Welcome to this event, this seminar on scaling up green finance, the new role of regulators and central banks, which is a World Bank Group event organized in partnership with the Network for Greening the Financial System. My name is Martin Wolf, and I work for the Financial Times. I've been very interested in this issue, which I think is immensely important. It seems to me, just to frame incredibly briefly the discussion, that there are at least three big issues that need to be addressed and considered in this session. First, how are we going to get the finance needed to meet the extremely ambitious global targets for management of climate risk? Obviously, this is not just about finance, but finance is a necessary condition for the transformation of the world's infrastructure above all. And that has to happen now, because the infrastructure we now build will essentially determine whether we will manage to hit the targets the world has set for itself. Secondly, particularly in this context, the assistance and help will be of particular importance for emerging and developing economies for two reasons. Many of them obviously have greater difficulty in accessing first-rate finance for infrastructure. And second, crucially, these are the growing economies and therefore it's really on whether their infrastructure is transformed that success in meeting these targets will depend. And finally, of course, there are issues for the financial sector and the risks it can bear and how it manages those risks, including climate risk. And I would stress, as I've done in many pieces of writing, this is all very urgent. It has to happen now. In fact, it should have happened a very long time ago. We don't really have the time to dawdle, and I'm afraid I start off from a very pessimistic view on where we are now, or you might say a very challenging view. Now, before our panel discussion, and before I introduce the panelists and that discussion, may I call on Mr. Hossain, who's Chief Executive of OJK, the Indonesian FSA, to give us a keynote address. Thank you.
The Honorable Vice President and General Counsel, Legal, Compliance, Risk and Sustainable International Finance Corporation, World Bank Group, Mr. Ethiopius Tafara, representative of international organizations and government agencies, distinguished guests, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon to you all. First of all, please accept my warmest welcome to all of you to Indonesia, and particularly to this beautiful island, Bali. It is such an honor for Indonesia to be hosting this event alongside the World Bank IMF annual meeting when the world is coming to Bali. The theme of this event, namely the new role of regulator in sustainable finance, is also very relevant for an issue as important as sustainable finance. Distinguished guests, ladies and gentlemen, since 2012, OJK with other financial regulators, central banks, and banking associations from 9 countries agreed to establish the Sustainable Banking Network. Currently, the network comprises of membership from 35 countries. This achievement can certainly be appreciated, and we have seen that over the past 6 years, the network has gained very good response from the public. At present, the sustainable business response continues to increase, especially since the launch of the Sustainable Development Goals, although there have been previously voluntarily adopted initiatives such as the Equator Principle, launched in 2013 with IFC support. The Equator Principle is an environmental and social risk management framework established by financial services institutions in order to determine, assess, and manage environmental and social risks. Especially in its initiated project as of April 2018, this principle has been adopted by more than 90 financial services institutions from 37 countries who were committed not to provide loans to projects worth $10 million or more if they do not meet social and environmental compliance standards. As for Indonesia, there are two major and interrelated agendas in which Indonesia is involved, namely the drafting process and the declaration of commitment to implement two agendas, namely Sustainable Development Goals and the climate change. The commitment is stated in Law number 16 of 2016 concerning Paris Agreement to the United Nations Framework Convention on Climate Change, and Presidential Regulation number 59 of 2017 concerning implementation of achieving Sustainable Development Goals. Through the Paris Agreement, Indonesia's commitment to reduce greenhouse gas emission by 26% at its own expense or up to 41% reduction with international support has been translated into a national action plan for the reduction of greenhouse gas emission. Such plan states that the 26% of greenhouse gas emission will come from forestry, 50% from peatland, 3.8% from energy and transportation, 18% from agriculture, and 1.8% from industry, and the last one is 5.9% from waste. The implementation of the government's commitment is the manifest into a short, medium, and long-term work plan. The work plan is implemented by elaborating on the plans that already exist in each ministry and institution. However, many problems remain, particularly on harmonizing various cross-sectoral ministerial and agency issues that arise among them. As a form of support to the government's commitment to implement sustainable development and the climate change, OJK has issued a sustainable finance roadmap in 2014 in collaboration with the Ministry of Environment and Forestry and IFC. The goals of the Sustainable Finance Program in Indonesia are to improve the financial service industry, resilience, and competitiveness. This is to enable them to grow and develop in a sustainable manner. The second one is to provide financing resources required by the public by using the pro-growth, pro-job, pro-poor, and pro-environment. And the third one is to contribute to the national commitment to address the global warming challenge. This is done by carrying out climate change mitigation and adaptation in business activities towards a competitive low-carbon economy. Sustainable finance in Indonesia is to be achieved in the medium term, means the 2015 up to 2019, and the long term is 2015 up to 2024 by the financial services industry under the supervision of OJK. Given such, OJK carefully determines and prepare the benchmark for improvements in sustainable finance to have ensured this achievement. Indonesia, which currently needs fairly high economic growth to take advantage of the demographic bonus and to get out of the middle income trap, requires a fairly large amounts of energy supply. In the long term, the distribution of sustainable financing to strategic sector industrial is expected to encourage sustainable economic growth, which in turn will provide a large larger market for financial service industry or institution. Distinguished guests, ladies and gentlemen, in the implementation of the Sustainable Finance Roadmap, OJK as the regulator to the financial service industry has issued a policy on sustainable finance, namely OJK Regulation number 51 of 2017, concerning implementation of sustainable finance for financial services institutions, issuers, and public companies. In addition, we also issued OJK Regulation number 60 of 2017 concerning issuance and requirement for environmentally sound debt securities or green bonds. Through the regulation of sustainable finance, the financial services industry is requested to increase its contribution to the sustainable development and climate change activities. This includes the development of financial services products and the enhancement of environmentally and socially friendly portfolios, in line with the targets set in the Sustainable Development Goals and climate change. OJK plays a role in achieving this commitment through its Sustainable Financial Program. This program is carried out through the cooperation of various parties, including IFC, to support the industry that implements sustainable finance principle. Esteemed guests, ladies and gentlemen, this year is the first implementation of sustainable financial policy in Indonesia. The first financial services industry implementing this policy was the banking sector, with several obligations imposed, which includes the increase in portfolios in accordance with the principle of sustainability. The initiative is to be followed by the capital market and non-bank financial industry in 2020. In the Indonesian capital market, the plan to increase financing is done by developing an environmentally based share index, or we call it the green index, creating green instruments such as green bond and green sukuk, and listing of environmentally friendly listed company. An environmentally friendly share index will help boost the reputation or image to a company, which in turn will help in securing financing as well as encouraging improvement in the environmental management of business activities. In the development of the green bond instrument, which is a new product in Indonesian capital market, OJK refers to internationally recognized standard, namely the principle of the green bonds issued by the International Capital Market Association. Financing increase in the non-bank financial industry sector can be done by encouraging the industry players to ensure their business within the framework of minimizing environmental risks. In addition, the industry players are also encouraged to design an environmentally friendly insurance product to provide greater variety of product options to the public. Regulatory support, along with the sufficient financial service institution oversight, as well as supporting infrastructure, are essential to increase funding in the aforementioned priority sector. Development of the supporting infrastructure should mainly focus on the provision of information and improvement of the capacity of the financial service institution practitioners, as well as the project proponents in the area of project financing analysis and risk assessment. We believe through joint efforts and hard work, and not to mention capacity building programs that we carry out in collaboration with IFC, financial service industry has gradually but steadily understand the aspect of sustainability that involves social and environmental risks in their business process. Distinguished guests, ladies and gentlemen, we expect that all this effort will be supported by the granting of the increased funding for sustainable development and long-term development plan and medium-term development plan for 2015 up to 2019. The financing needs for national development are envisioned to be obtained through those three sectors of financial services industry. On this occasion, we would also like to congratulate the Sustainable Banking Network with the support of IFC's expert team for successfully launch creating green bond market report. OJK played an important part in the review process, co-chairing in the Latin America Banking Federation and Moroccan Capital Market Authority. To conclude, the current changes affecting the economic, social, and environment deserve the regulators' close attention and leadership. Regulators are expected to give direction, create conducive situation, and provide solution to problems as they occur. However, regulators can only support from the supply side, and to stimulate the demand side, collaboration with the government is mandatory. And to ensure financing for sustainable development goals and climate change goals, collaboration should be extended to all levels, be it national, regional, and global levels. To close my speech, allow me to express my gratitude to all of you for having spared your valuable time to attend this event. Your attendance reflects the commitment, support, and contribution towards the creation of new environmentally friendly economic activities. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.
So thank you very much, Mr. Hussain, for giving us an outline of these remarkably ambitious and comprehensive plans for what is, of course, an extremely important emerging economy. Let me now introduce the panel and start getting towards the panel discussion. So immediately to my left is Mr. Mark Carney, Governor of the Bank of England. Immediately to his left is Mr. Henrik Braconnier, who's Chief Economist of Finansinspektionen, the Swedish FSA. I apologize for mispronouncing it. I'm sure I managed that. More mispronunciation about to come. Monsieur François Villeroy de Gallo, who's Governor of the Banque de France. To his left is Ms. Shamsia Yunus. I've been instructed that I'm allowed to abbreviate her name and titles to that, who is Governor of the Bank Negara Malaysia. To her left is Ms. Neja Hayat, who's President of the Moroccan Capital Markets Authority. And to her left, but only to speak at the end, is Mr. Joachim Levy, who's Managing Director and Chief Financial Officer of the World Bank Group. I hope I got all that right. So before we start, I'm going to invite Mr. Frank Elderson, who is Executive Director of the Dutch Central Bank and the Chair of the Network for Greening the Financial System, to give us some remarks.
Thank you very much. I was asked to give some impulsive remarks, but I won't be impulsive. But I won't be impulsive. And I'm also not going to make jokes. I learned this from Mark Carney when you gave your famous Strategy of the Horizon speech, and you introduced the subject by being so important that you said you were not going to be making jokes. And I won't be doing that either, but I am going to express some optimism and some confidence. But I will start by referring very briefly to the latest IPCC report, which of course is a very stark reminder of the severity of the challenges that we all face. It also calls for an economic transition so abrupt that it has no documented historic precedents. So there you might think little cause for optimism. But although the effects of climate change are increasingly visible, there is cause for optimism. Within the scientific community, there is now broad international consensus about the need for urgent action. The IPCC report, for example, is based on thousands of studies from scientists from over 40 different countries. So now the time has come to forge this same broad international consensus, but in the financial world. And when I look at that, at what the Network for the Greening of the Financial System has achieved in such a short time, I am indeed confident. In under 1 year, we have grown from 8 to 18 members and 5 observers, spanning 5 continents. Even this morning, a new member joined, so now we are actually 19. And I'm glad to welcome the Bank Negara Malaysia to the network. And the further good news is, yes, I think that is an applause. Thank you, thank you. And the further good news is that a lot of hard work is ongoing. Today we published the first progress report. And some of the key messages I will give you. NGFS members acknowledged that climate-related risks are a source of financial risk. Now this is easily said, and it is maybe very obvious to those who have given thought to this, but this is a landmark statement. We have now understood that indeed this is a source of financial risk, and it brings this squarely within our mandate. The mandate of central banks and supervisors to ensure that the financial system is resilient to those risks. NGFS members, as well as financial institutions, are deepening their understanding of these risks and the need for an improved approach. The tools and methodologies, however, are still at an early stage, and there are a number of analytical challenges. We, and also financial institutions, need to develop new analytical and supervisory approaches towards climate risks, including those based on forward-looking scenario analysis and stress tests. Lastly, central banks are also increasingly playing their part in scaling up green finance, for instance by accounting for climate and environmental related factors in their own investment strategies. In the coming months, the NGFS will carry on its work on its first comprehensive report to be published in April 2019, I'm sorry, next year, this coming year, April. You can build on the network's momentum, learn from our experiences, and we can learn from yours. So please share your experiences with us, exchange your views. And now let's do exactly that. And I'll be short, and I'll end my introductory remarks here so we can listen to this most distinguished of all panels. But not before me also thanking the very gracious hosts here of Indonesia and Bali. And you, of course, also, Joachim Levy, who has been a pillar, I think, really, under our joint efforts. So thank you very, very much for having me here on stage. Thank you.
Thank you very much for introducing both the issue and the NGFS and emphasizing the importance of this. So let us now start our discussion. So I'm going to start with you, Mark Carney. You actually were one of those who was one of the leaders, I think, in bringing this to the attention of the world as a significant financial issue. So could you explain why climate risk is a significant financial risk? And how does it relate to the other financial risks you're worrying about all the time? I mean, is it just another of these risks, or is there anything distinctive about it?
Okay. Thank you, Martin. Let me just very quickly commend Frank for his leadership of the NGFS. Thank Joaquin and the World Bank Group and our Indonesian hosts for the sponsorship of this and for what you're doing on these issues. Let me go quickly through the risks so we can get into the meat of how to deal with them. In terms of climate-related risks, we can basically put them into 2 buckets. One are the physical risks, so think damage from storms to property, buildings, business, supply chains. And just to put some numbers around that, the number of extreme weather events has tripled over the course of the last 30 years. Won't be a surprise to anyone really in this room. But the real value, the real cost of those, insured cost, has gone up 5-fold in same dollars. So you have physical risks that are manifest, and that's the immediate. But the bigger risk for the financial sector are so-called transition risks. And that's the risk of that comes with the transition to a lower carbon economy. So it's the good news in that we're moving to a lower carbon economy. But as you move, and depending on how quickly you move, certain business models, assets change in value and could change quite dramatically in value. And as Nick Stern taught us a long time ago, unfortunately it was a long time ago, it would have been good if we followed the advice then, that moving early is much less costly than moving late. And so the biggest risk, of course, people move late and abruptly, whether that's for whatever motivation, whether it's climate policy or other motivation. And then that is borne by the financial sector. So what's distinct about these risks? I think climate risks are somewhat distinct relative to other financial risks in a certain respects. First, climate risks are far-reaching. They're very broad. When they manifest, they will affect a broad range of sectors. They'll be nonlinear and they'll be correlated. And so that's one of the reasons why this is, even though it's potentially beyond the short-term horizon of some financial actors for financial policymakers, objects in the mirror are much closer than they appear. They will become much more severe relatively soon. The exact time horizon that those manifest is uncertain, so there is uncertainty about that, and of course that's the transition risk. And then the third thing is, again, your protection against the risk or the exposure you have to risk depends on your short-term actions. So near-term actions can make a big difference to exposures. And think about moving a very large portfolio, whether it's of investment or lending, to reduce your transition risk over time. It will take time. Acting early will help you. Let me finish quickly with the specific sectors that are affected by the risks. The sector that knows the most about this, that lives it every day, is property and casualty insurance and reinsurance. And in the UK, one of the reasons I think we were amongst those who were earliest is we oversee the third largest insurance market in the world and one of the largest reinsurance markets in the world. And they are repricing these products every day and changing coverage, pulling in coverage because of the manifestation of physical risk. That which was in the tail in the past is now in the central forecast in that business. Secondly, on the other extreme, you have banks. And banks have a relatively short horizon. Average duration for UK banks of their loan portfolios is about 4 years. And so for them, the physical risk, they can insulate themselves from the physical risks, and these transition risks are unlikely, at least that's what they would have said several years ago, would unlikely to manifest, and they used to view climate-related risk as more of an ESG risk, a reputational risk. What's interesting, partly through the work of the NGFS, our own work at the Bank of England, we have just surveyed banks that control 11 trillion of assets in the UK, and now 70% of them view climate, as Frank just said, as a financial risk. So that horizon has started to come in. Now, how they're going to manage that risk is the next question, but admitting you have a problem is the first bit of solving it. And then lastly, there's everyone else in the financial sector. So I mentioned insurance, but think asset managers, other pools of capital such as pension funds. And what they're starting to realize is that these transition risks are relevant for their horizons if they stretch out, and certainly if you're a sovereign wealth fund or a pension fund, they're there. Or they are relevant because there is some evidence, and I wouldn't say it's absolutely conclusive, but many point to it, that the types of companies that think about big structural issues like climate change, think about other big structural strategic issues like aging, the advent of artificial intelligence, these longer-term issues of value creation or value destruction. And so because of that correlation, it is somebody who manages climate risk also manages value. The punchline on that is when you add up all those investors, those banks, those insurance companies who care about climate risk, as of 2 weeks ago, the number of assets that they control that support at least climate-related financial disclosure is $100 trillion US. So this has become mainstream.
Thank you very much. That certainly sets out the issues from the risk management point of view. May I turn now to Henrik Breckenjek to comment on how you see climate risk from the vantage point of your mandate, and whether you see it similarly to what Mark has just indicated, or were there different nuances from your point of view?
Thank you. Yes, I'll try to delve on that. First, I think we all can agree on that climate change is a test for policymakers. It's a test for policymakers across borders. It's a test for policymakers across policy areas. And therefore, it's necessary for financial regulation to play its part. And that's, of course, why we're sitting here. The financial sector is mainly indirectly connected to sustainability through the services and products that it provides to the non-financial, I'm sad to say, sometimes non-sustainable, non-firms. Having said that, it's still the case that the market failures that we see in the real economy creates market failures in the financial sector through the pricing and risk profiles of assets, and therefore it provides risks in the financial system. And I think that's sort of a very natural starting point for a regulator. Finansinspektionen is both a prudential and a conduct regulator, and hence our task is to maintain a stable, well-functioning financial system with high consumer protection. And in order to do that, we need to manage these risks as we try to manage other risks in the financial system. If we start with a prudential perspective, climate-related risks to some extent translate into what we see as the traditional risks, and with traditional risks we mean credit-related risk, market-related risks, insurance-related risk, or operational risks. So from that perspective, it's just another part of our bread and butter. Knowing our bread and butter, however, also means that this is quite complicated. And what is perhaps most difficult or most hard to grasp when it comes to climate-related risks is the fact that for many other risks, we are uncertain whether historical patterns will prevail in the future. When it comes to climate risk, we're sure that historical patterns will not help us understand what's going to happen in the future. So we have uncertainties here that are not sort of comparable to what we see in many other areas. Just to give you an example of the sort of prudential perspective and the risk that it could pose, was a month ago, we saw unusual price spreads driven by extreme weather conditions in the Nordic countries, combined with price changes in the German electricity market, partly driven by the EU ETS system, so that's policy-related risks, that led to default of one of our members in a CCP in Stockholm. And it actually led to the distress of the whole clearing system in that part. This was a small part of the full clearing system. It was a small niche market, but it tells us something what could happen in the financial system in a future crisis. Moving over to market conduct perspective. We mainly see our task here is to enable consumers and investors with strong preferences for sustainability to choose the correct products. In some sense, to go ahead before policymakers and markets in order to invest where they think they want to invest. And if they're not able to do that, if they invest in firms that pretend to be green or whatever, they will lose confidence in the system, and the system will not provide the impact on sustainability that they and everyone else is expecting. So from the conduct perspective, transparency is therefore a key issue in order to counter greenwashing and making sure that we can maintain growing green financial systems. And that is one reason why we think disclosure is important. That's part of the job that the NGFS is working on. And this is also one reason that we're at Finansinspektionen has been pushing for the IOSCO to start a green financing network, which we hope IOSCO will say yes to next week, to improve global disclosure on these issues. So to summarize, climate-related risks are relevant in all parts of supervisions, but partly in different ways. The prudential perspective, it's risks that are mainly related to an abrupt transition, as Mark said, the transition risk. And the conduct perspective is really about providing consumers and investors with sufficient information to make informed choices. Thank you.
Thank you very, very much. You made many very important points that I thought among the most important is the inherent uncertainty which we operate in moving into what is a new world, while in other areas the nature of financial risks would seem to be better understood, though being the cynic I am, I might note that this hasn't always proved to be the case in the way the financial sector manages risk, like, for instance, lending for housing, which is a pretty well-known activity which they should have been able to manage.
Understood in hindsight.
Yes,
Martin. Yeah.
yes. The other thing that I'd like to come back to, I was thinking about very closely what you said, Mark, which is I want to get in my mind how you see the relationships between what you call transition risk and what I think of as non-transition risk, the failure to make transitions and therefore the catastrophe that, I mean, there are risks associated with doing things and risks associated with not doing them. But now may I turn to Francois Villeroy and ask you about why or to what extent do the usual ways of dealing with risks not work in the context of the impact of climate change, and what tools can and should supervisors rely on for measuring and managing these risks, which is sort of follows naturally from the two presentations we've already had.
Thank you, Martin. And let me first stress, after Frank Anderson's words, how glad we are with the success of this network for greening financial system. It was an initiative we at the Banque de France launched in the last One Planet Summit in Paris last December. We provide the Secretariat under Frank's chairmanship, and frankly the success went beyond our expectations. We now have an acronym, which is probably the best proof of success, NGFS. We more than doubled our membership, and welcome to the latest members. And still more, there is around the table, it's a coalition of the willing, so much enthusiasm and energy, which is usually not associated with central bankers and supervisors. Let us put it this way. I heard you, Mark, saying that it's probably one, and the Bank of England is very active, one of the most exciting things having happened in green finance in the last years. We wouldn't expect an exciting thing coming from supervisors, but this is the case. To go to the substance, how can we help, including measuring risk, which is your point? Clearly, we cannot, and this must be clear, we cannot compensate for the lack of some adequate policies, including very probably one day some carbon pricing. But we can be extremely instrumental in integrating the measurement of financial risk in all economic decisions, financial risk linked to climate change. And let me mention 3 possible axes, or if I use the Japanese style, perhaps 3 arrows. The first arrow is the snapshot of risk. This is obviously the question of awareness and disclosure by financial institutions. And here, the TCFD, the Task Force on Disclosure chaired by Michael Bloomberg under the FSB umbrella, is a decisive progress. We can still progress, probably, towards a common taxonomy, if possible, simpler and broader. And we study in the NGFS data collection issues we have, having shared and good quality data. We are not yet there. But this is the first arrow. And then we could consider on disclosure how to evolve from a voluntary disclosure to a mandatory one in a comply or explain approach. In some jurisdictions, including France, there is already a mandatory disclosure for asset manager and insurance. Second arrow, lead by example. For us, central banks. Banque de France was among the first central banks to adopt last March a charter on responsible investment for our own funds and pension portfolios, so around 20 billion euros investment. And I'm glad to announce that we are working to publish in the near future a TCFD-like, as close as possible to the TCFD disclosure, a TCFD-like reporting on our relevant portfolios. Third arrow to conclude, I spoke about the snapshot of risk. But beyond that, we should work on a video of risk in a more dynamic perspective, using forward-looking stress tests. This is technically much more challenging, but we believe that it could be a very powerful tool. We are working on two key issues for that: how to translate climate change scenarios into economic scenarios. And you mentioned, Frank, one important event last Monday, which was the IPCC report. Can I mention another one, the Nobel Prize, going to William Nordhaus, who was one of the first economists to work on the so-called DICE model, Dynamic Integrated Climate Economy model, so to translate climate change into economic effects. The second issue we have is how to assess the impact of such long-term shocks on the probability of default over a much longer horizon than the usual one of 1 year. We are accustomed to deal with financial risk with short-term to mid-term horizon. We should now increase our time horizon to take into account the climate risk. Having said that, it's clearly a long-term challenge. But Martin, as you said, there should be a feeling of urgency. Time is running out. It's why we are working so actively. And so our next step will be the publication of the full report. It will happen in Paris next April, and you are all welcome. Thank you.
Thank you very, very much for bringing out both the intellectual clarity. Why am I not surprised that you come up with 3 points? And making clear of what exactly the central banks can do in this regard. May I now turn to Governor Yunus? Could you tell a little bit about how this issue we're addressing looks from the point of view of a fast-growing emerging country like your own, and I think particularly in the context of Islamic finance, which is something that interests you a great deal, I know, and how that will relate to the challenges of a low-carbon transition, the sort of thing that we got in the keynote from Indonesia, and also achieving the vital two goals of development, inclusive development, and managing financial risk. So how do you perceive this?
Well, for Malaysia, sustainability is a national agenda, and we have strategic plans that are being implemented, particularly in the palm oil industry, the renewable energy, and green technology. And these are all being implemented so that we can, as a means to realize the 2030 SDGs. And for us, finance plays an important role in realizing this vision. So, getting on to Islamic finance, when we first introduced Islamic finance, it was for the reason of financial inclusion, given our demographic profile. And no one is to be excluded from participating in the formal financial system just because of the beliefs that they have. So that was how Islamic finance was first introduced in Malaysia. And 3 decades on, it has matured and is now an integral part of the formal financial system. And so now we are evolving Islamic finance to focus on delivering value and impact to the economy, the society, and environment. And for us, this is a natural next step to Islamic finance. And green finance helps to achieve both goals. That means climate resilience and inclusion in 2 ways. One is by aligning values and impact. For us, Islamic finance and green finance have common objective, that is to preserve the environment and the planet, in addition to life and wealth. And for this, last year, we issued a strategy paper on value-based intermediation. And recently, we have also issued 2 consultative papers on the impact assessment framework and the value-based scorecard, so that there is a much more structured framework to help the Islamic financial institutions realize the full potential of Sharia finance, and how we can then measure the impact that Islamic finance have on the economy and in realizing the sustainability agenda. And for us, Islamic finance is a uniting force for good. And this framework that we have evolved has one of the advantages that we have seen in coming up with this framework is it has brought together all the stakeholders that have this vision together around the table, and for us to be able to advance finance in a form that delivers positive impact to the economy, to society and environment. And secondly, we see that green finance helps the mobilization of capital towards a much more sustainable economic activity. We started with a green technology financing scheme in 2010, which was a collaboration between the government and the private sector. And for an emerging market, we find that when we venture into something new, awareness is a big challenge. And one of the ways that we try to promote greater awareness is to provide incentives. And one of the ways in terms of catalyzing the awareness on green finance, green technology, was through introduction of such funds where we give soft loans, but it is a well-defined parameters with, and we did say that the fund size was about 1 million US dollar, and it was granted to about 30 companies, so that we are able then to generate the kind of awareness and the benefits that the companies can see accruing to them adopting green practices in their businesses. And we are also promoting green sukuks. So far, we have had the issuance of 7 green sukuks in Malaysia to support infrastructure developments in solar energy and green building. But for us, our journey has only begun. Like I said, changing mindsets will take time, and for us, especially in emerging markets, that process is much more difficult with the absence of a pool of what we call impact-focused investors and funding providers.
Thank you very, very much for that introduction. Raises lots of fascinating questions. May I then finally turn to you, Ms. Hyatt. I know Morocco has been accelerating activities in this area since COP22 in Marrakesh. So what have you learnt in the process, and how do you perceive the challenges?
Okay, well, thank you. First, I'd like to start by reminding that Morocco has been engaged for over 2 decades in a voluntary approach to strike a balance between economic, social, and environmental consideration. It's a country and resolutely committed in favor of climate. Morocco launched different initiatives. One of the most important is the National Renewable Energy Efficiency Plan, launched in 2008, with the objective of having 42% of the total energy produced from renewable sources, solar, wind, and hydroelectric sources by 2020, more before COP22. During the climate summit held in Paris in 2015, His Majesty King Mohammed VI announced that Morocco will achieve, or should achieve, 52% of its electrical power from renewable energy and in 2030. And this is the most ambitious renewable energy program in the region. So this is the context. Then the momentum was COP22. We'd ask, so what a capital markets regulator, and that was recently in that, coming from the banking side, recently at that function, what was our, what has been our role. First, coming to this job, one of my main, the main issue I wanted to address is how capital markets in my country could contribute in a more efficient way to the financing of the economy and to finance investment and the real economy, because the figures are not, although it's a quite well-organized market, it's not that involved in the financing. So it was one of my concerns. Second, an opportunity, many projects coming. Morocco launched one of the one of the largest solar plant, and so what could capital markets regulators like MMC do? So we decided we didn't have that much time, but we needed to do things properly, not only to give a clear framework for issuers, but also for investors, both local but also global. So so our first action has been to publish, with also the support of IFC, what we understood was the first guideline on green bonds launched in Africa, and it enabled issuers to come issuing green bonds, corporate, Mazen, the Moroccan Solar Sustainable Agency, also 3 banks. In last year, these issues counted for 18% of the corporate issues, which is a good, which was a encouraging ratio. And today we are going further, because we have launched also understanding the projects that are that need financing, but also the new appetite of investors, even local, not only the global, the funds keen in. We launched the sustainable and social guidelines, and there are 2 issues that will come soon. Of course, in these guidelines, we wanted we set ground rules based on, as I said, international best practices to ensure a secure, but in a rapid way, a secure development of this market. Meanwhile, because on the relations with COP22, we had COP22 was the COP of the financing, but it was also the COP for Africa. And we imagined, we encouraged, and we're part of a commitment called Marrakesh Pledge to foster green capital markets in Africa, and that has been followed by 26 African countries. More have come since, represented not only by the regulators, but also by stock exchanges. And it was, at the time, the first voluntary commitment to support green finance on a continental level, because we feel that we can, as one of the financial hubs in the continent, Morocco could play a role in attracting funds that are supposed. Well, I mean, there have been many statements talking about billion of funds that are ready to come to finance sustainable projects. So we think and this platform that we launch is a first tool to raise awareness, share expertise, and inform about what countries in the regions are doing. So basically, this is one of the first. We have done more progress and many other actions, but we have been looked at, and we've shared expertise mainly on the way we addressed quickly, but in an efficient way and a flexible way, the financing of more is to come. And I agree with Governor of Bank of France. We might have to also work with on the legislative side, but these guidelines, being very clear, are a first step to develop this market. So
thank you very much. This is very, very interesting. I just wanted to remark that we did start a little late, but I'm going to try and finish on time. In about 10 minutes, I'm going to, depending on how well this goes and how disciplined everybody is, to go and ask for questions from the floor. So if you have questions, you might like to think about them now. There won't be much time for them, so they will have to be very brief and pointed, but just to give you notice. I just want to pick up a point which was raised in the opening, and I think has come out very clearly in the different flavor of the discussions. So there are two ways, it seems to me, that are very crude. You divided things up, Mark, into the real side and the financial side. So this fits, I think, in a way with what I was sort of thinking about. One way we can think about what we're talking about here, and it's clearly a dominant aspect of what you've been talking about, particularly for the first three of you, is how do you protect the financial system from climate risk? So we don't want some huge financial crisis because they've completely mismanaged some very important risks. But obviously, particularly, this came out very clearly in the last two presentations, there's also the desire to protect us from physical climate risk through finance. And what the question I had is how far you think that the sort of things you've been talking about, and the first three of you talked about them very clearly, in what I would define very broadly in the prudential regulation area, is going to affect what the financial sector in the end does to protect us all as human beings from the real physical risk, which I suppose probably bothers us more than whether the insurance business collapses.
Well,
how do you see the relationship?
Okay, I mean, make no mistake, we're not sitting here saying as long as the financial sector is okay and the planet burns, everything's all right. I mean,
that is sort of what I'm getting at.
That is the point of the tragedy of the horizon, is that that's the horizon of the thing. But and the second point, and Francois made this, others did as well, but Francois started with this, which is that the other authorities are going to set the climate policy framework, and finance is going to react to that. Now,
that's exactly the issue I want to
That's exactly, so core issue, and let's start with Paris 2 years ago, and 1.5 degrees stretch target, 2 degrees, 190 nations signing up, and now looking by and large to implement. Companies have to disclose, or don't have to disclose, but there's 100 trillion of assets who are now looking for companies to disclose. There's regulators and the companies that they supervise who are looking at managing these risks, and there is the potential for a virtuous cycle to develop because that which gets measured gets managed. If there is prospect, if there's credibility in climate policy, companies that have a longer horizon who can anticipate that there will be a price on carbon more universally, just to use one example of those policies, that price will ramp up over time, that being early could give them advantage. Those companies will be rewarded by investors who have similar horizons, and others who are laggard will be penalized. And so you get the market starting to pull forward future policy action of governments. I'll use governments as the climate regulators in that example. And the way you start to as well supplement that from a risk management perspective is to do, again, what was raised, is look at what's called scenario analysis on an individual company basis. So one of the elements of the climate disclosures that is encouraged is to say, what would you look like in a 2-degree world? And run a scenario and suggest what your portfolio would look like in a 2-degree world. And that helps
the providers of capital, which in the end is all of us, whether it goes through a bank or a pension fund or a mutual fund, make a decision whether that's a wise thing to do. You can potentially map that into stress testing, which again is taking climate risk to financial outcome to stress. Now, last point, just to flip it around. So we look at risk and managing the risk, but of course the flip side of that is the opportunity. Again, if there is credibility, there doesn't have to, you're an expert in many things, including monetary policy, but you know the power of credibility in monetary policy. You have to do less today in monetary policy if you have credibility about what you're going to do in the future. And so for climate policymakers, if I can use that term for governments, as they build a track record of credibility, if there's the disclosure, including some of these sensitivities through scenario analysis and stress tests, then those providers of capital can move assets in that direction, and then it encourages activity elsewhere just from the power of the market.
May I just follow up? I know you wanted to say something, but I have a question which might fit into what you have said. If not, you can go into it, and others might want to. I've sort of been thinking, following what Mark Carney just said, and I've been thinking about this some time. Is it imaginable that if you fully internalize the risks, so people are aware of what climate change might do to their business, the risks associated with these things being unmanaged, the policy system, I think you mentioned this, pricing and all the rest of it, actually becomes redundant? And how far, in other words, and this is obviously very important given there are some rather large potential free riders in the system, I don't need to mention them, how far would the proper internalization in the financial sector of the risks associated with unmitigated climate change through the mechanism of the pricing of finance actually bring us where we want to be without policy? But that's a question I have. Others might want to comment on that. I have a view on this, but I know you wanted to say something anyway.
To put the question in other words, and we have sometimes this doubt saying to us, it's a question of the plane crash, and saying, so you provide financial interest for the passengers after the airplane crash, but how can you avoid and prevent the crash?
You make the insurance very expensive, and then the airline operates better.
Let us be clear, and I stress this point, and this is a direct answer to your last question. We cannot compensate for the absence of adequate policy. We cannot take the small monkey of climate change on our shoulders and say to policymakers, don't worry, we will be a substitute for your inaction. It will not work this way. So I don't believe that the integration of financial risk will ever replace adequate regulation, transportation policies, carbon price, etc. Having said that, we can help preventing the airplane crash, at least in two ways. The first one is the one Mark just stressed. If we align the incentives, especially with dynamic stress tests, it will help for sound economic decisions by private investors. And good financial signals integrated the long-term climate risk will help for sound economic decisions. And the second is more on the opportunities side. You mentioned it briefly, but it has been less a focus today, about green bonds. Because here finance can be extremely helpful in financing all the investment required by the energy transition. And we know there are huge figures. It's often mentioned 100 trillion of infrastructure and energy transition investment in the decade to come. I don't know if this figure is precise enough, but in any case, it's significant. And here it's a case where finance already helps, but we have to increase the qualitative content of this green bond while developing the quantitative amount, which is also an interesting challenge.
So one way of thinking about it might be, there are many different ways, that if you do what you do well, you would turbocharge policy, you would reinforce policy, if only there were any. Sorry, but this. Before I go to the floor, do any of the other three wish?
This is the talent of journalists to sum up
to
a long
simplify
thought in a small sentence.
To simplify and confuse.
Can I just simplify and exaggerate, actually?
I was being more modest.
But I think that's right, turbocharge. Just one other point, just to reinforce what Francois just said. There's many reasons why we don't substitute for climate policy. But the most fundamental is outside of our mandates, our remits. But even behind that is that these decisions are societal decisions. They will require major adjustments, as the IPCC report suggested, at least directionally, right? Major adjustments to the structure of our economy and society. And so society has to get behind, through their governments, these types of changes. But as that track record builds, if it's credible, your point, these types of incentives, dynamic stress testing, disclosure, supervision, can turbocharge those actions, those climate policies.
Essentially, it reinforces the internalization process.
Absolutely.
Which is what
pulls it forward in
Henrik
time.
was emphasizing in his remarks. Does anyone then briefly want to add anything to what we've said, particularly from the point of view of emerging countries? Because for you, obviously, getting the infrastructure invested in, making the finance available for that to happen, is the overwhelmingly dominant concern, rather than managing the very complex financial risks of, say, financial centers like London or Paris. So how do you perceive that?
Yes, it is much more challenging because
Increasingly important ones.
No, because the level of literacy, level of sophistication of businesses in emerging countries are much less compared to developed countries. So for us, like what I said, at the end of the day, the businesses, when the outcome that you want are driven solely by policies, that is seen as a cost to businesses.
Of course.
And the buy-in that you will get from the businesses is going to be much less compared to a system where they can see that, taking on that practice that is going to help their bottom line. And that is why for us in Malaysia, we find that every time that we want to nudge the businesses into a much more sustainable practice, finance plays a very key role. Finance does play a key role in terms of pricing, in terms of even access. And once they realize that it's not just paying less for my loan, but it does mean healthier bottom lines, then you will get that buy-in, and that will provide the catalyst for others to be able to then follow suit. So yes, for emerging markets, the balance is much more skewed towards finance, not just to drive sustainable practices, but also in areas like encouraging them to adopt even sound governance practices. We find that finance does play a role.
Is there anything you wanted to add, Ms. Hyatt, or should we go to the floor?
No, just saying that in our case today, the challenge is not only about financing through capital markets sustainable projects or climate-friendly projects, but how to use more capital markets. There's obviously the need for awareness, for also disclosure, for convincing issuers, but also give more explanation to investors. So we need first to use more capital markets, and it's our challenge. And the sustainable projects are a very good opportunity to do because it's a national. It's a national policy.
Well, obviously, one of the key issues, which I think several have mentioned, that these capital markets we're talking about, that in London, for example, finance globally, and linking what they do up with what you're doing is obviously really very important, because that's where most of the investment is actually going to occur. May I turn to the floor? I'll take a couple of questions, be very, very brief. If it's for individuals, it would help, but otherwise I'll just allocate it arbitrarily. Does anyone have any questions? A lady here. Is there a microphone, by the way? There is a microphone over there. Could you stand up, please? It would probably help. Perhaps very briefly say who you are and who the question is for.
I'm Miriam van der Stichelen from SOMO, and I'm following closely the sustainable finance agenda in Europe. I have a question. Given the urgency, are the supervisors and regulators willing to develop what is called in Europe a brown taxonomy, basically saying some things really can't go in? And my second question is, given the current volatility, how far can we really combine sustainable finance with the problems of volatility that we're seeing? So the stability of the financial
volatility of what?
The volatility of the financial markets. Basically what you were, Mr. Wolf, talking with Madame Lagarde. So kind of how do we combine financial stability with sustainable finance?
Okay, and I'll take one more question. I think there was somebody over here. Could you stand up, please?
Hello, my name is Claire Healy with E3G, based in Washington, D.C. I'd love to hear the panelists' view on how we get the IMF to include disclosure and scenarios and stress testing in their Article 4 consultations.
Okay, that's a good question. Let me start with the brown tax. And does anyone wish to comment on that? Please.
No, I fully agree with your suggestion that what we urgently need is a brown taxonomy. Because, I mean, in terms of green taxonomies, there are lots of them around. In some sense, we have too many of them. When it comes to brown taxonomies, there aren't any. And if you want to get into the sort of prudential risks, then it's really a brown taxonomy that you would like to go for. So that, I fully support your views there.
So what would that, could you just explain for ignoramuses like me what exactly that would mean?
Basically, rather than saying which firms that are sort of
okay,
oh good, you focus on the ones that are really bad and which will posit the largest transitional risks. Once prices start to change, which kinds of lines of business, which kinds of firms, I mean, think of coal, for example. That will be the first to go.
So as a regulator, you would draw up a list of non-approved activities.
No, but it would.
I think that would create a few political. I'm with it, but my God, that will be explosive.
No, but if you want to go to actual action, think of risk weights. If they're sort of not aligned with risks, then you need something that targets.
There are different ways of doing this. Yep. Did you want to add anything on that?
Well, I think
I put it a bit crudely, perhaps.
No, you know, again, one doesn't want to have climate policy brought in through the back door through prudential regulation. Climate policy is the responsibility of governments. I mean, this is the proper allocation. Now, there is a question, though, which goes to the heart of this of, is the riskiness of brown versus green, is that properly measured at present in risk weights? And I think the question and Henrik's answer and some research we've done at the Bank of England, we published 2 weeks ago as part of a PRA study, at least for the UK housing market, showed that for the first time that actually after you control for things like income, because often there's a correlation between what's green and the income and location and other factors, relative to brown, that there is more of a differential in housing than is accounted for in the risk weights. So I think the type of scenario work and an analytic basis for this, not we can't put in place a carbon tax or a regulation, so let's get the prudential regulators to do our job. I mean, we just have to be upfront about that. In my view, that's not the mandate of the regulators,
But the regulators, given the scale of the risks and the proximity to the risks, and this is a lot of the work, the NGFS, a lot of the work is right on these microprudential risk factors, and the question, sorry to go on so long, but about, because this is crucial, about whether a green supporting factor or, as per the question, a sort of brown penalizing factor on assets, that would be based on the riskiness of the assets, not on the climate aspect. And as time goes on, one would expect those risk wedges to go up.
And information about their size would rise.
Exactly.
Can I just, perhaps, Francois, maybe somebody else would comment on this? But let's move on to the next question.
Yes, I will
in this,
the
volatility of financial markets, is this a feature or a bug from this point of view?
Very quickly about taxonomy. I completely agree we need a common taxonomy. We have too many of them and too sophisticated. Should we go from taxonomy to tax? This is a more tricky question. For the reasons Mark just explained. And the face-to-face is very simple. The industry is the financial industry is advocating a green supporting factor, diminishing capital requirements, and we supervisors are probably more on the side of a brown penalizing factor for obvious reason, but it should remain risk-based, as Mark just said, and not aspiration-based, and this is very important. On volatility, your point is a very important one. How can we have a longer-term horizon in financial investors' decision? I don't have the answer. I share your wish. Can I only stress that more and more savers, individual savers, are very sensitive to this climate risk and to sustainable development. So how can we translate this expectation from the civil society and from the savers to financial intermediaries? I don't have the answer, but here there is hope. And in the success of green bonds, it's a clear sign. About IMF and Article 4, I don't have the answer. I don't know, Joachim, if you can give the answer for the World Bank Group. Article 4 are more on a macroeconomic review, so this could be a technical answer that perhaps it will come more with what the IMF calls FSAP, so review of the financial sector, but I will leave it to the Bretton Woods representative.
I'm looking forward to that section of the Article 4 on the United States. I was just going to comment, there's been enormous criticism of central banks in this context of volatility in financial markets because they've driven, allegedly, nominal and real interest rates to unreasonably low levels. If you think that is true, then it ought to have forced the financial sector to have a longer-term view because it makes future risks more present. So they've been doing the right thing in this. It's another reason to defend their policies. And it's quite an important point. In a low interest rate environment, real interest rate environment, the financial players should take really quite seriously, not that they necessarily do, costs which are really quite a long time in the future. In a zero real interest rate world, they're present now at the same weight. Anybody else wants to add anything before I give Joachim the last word?
Can I make two very quick points? First, I would just like to comment what an excellent question that was about the IMF stress testing. I'm not going to answer it, but I think it was an excellent question. The second thing, just to go back to capital flows and volatility, to put some context on it. One of the huge opportunities over the course, in my view, over the course of the next couple of decades in fixed income capital markets will be, or could be, local currency infrastructure, energy, transportation infrastructure, effectively local currency green bond. That's one of the biggest opportunities in China. It's potentially one of the biggest opportunities in India. That's why there have been renminbi and rupee green bonds issued in London. Is not Paris, I might point out, but that's okay, maybe in time. That's why there will be opportunities, I think, across the emerging markets in these areas. But the last point is, in several years, if this goes in the right direction, I'm not sure they'll be called green bonds anymore. They'll just be mainstream local currency capital market instruments.
and that would reduce volatility.
The only concluding remark before Joachim has the very last word I'd make two. What I've drawn from this is there has been really tremendous progress intellectually and practically in thinking about the financial risk aspects of climate change, and supervisors, regulators are obviously much more aware of these risks than they were even a few years ago. And I think that's tremendously positive, not only because it should make the financial sector safer, which we should all pray for, but also because it might even lead to some changes in the allocation of resources. The second thing, however, we have to emphasize, is, and I think this is a complete consensus of everybody, it is not a substitute for policy. And the hope that central banks will save their bacon of policymakers, as they did in the last 10 years in saving us from the consequences of the financial crisis, would be an even bigger mistake than that was. I think that's not a universally shared view here, but it's my view. I think it's been a wonderful discussion. I've learned a great deal, which is always a good test for me of whether it's been a wonderful discussion. You have the last word, Joachim.
Thank you. Yeah, I'm supposed to provide closing remarks, which is not very easy after this insightful and vibrant discussion that you, Martin, led. But I'd like to thank you, all the panelists, for having advanced our thinking on the economic risks of climate change, and also how we can find ways to fund the mitigation and adaptation efforts that we'll need to face these risks. I have to say that we have the conviction that the contribution of central banks and regulators is really unique, because promoting disclosure and the understanding of risks, as well as the prudential response to them, are indeed key elements to provide the right price signals to change business behavior and consumer choice, and also to inform public policy, including how to deal with the externalities that exist with climate change. So empirically based adjustments of regulation can also have an important impact on facilitating the new investment flows, in particular also through our institutions. So this is also very helpful for multilateral banks in mobilizing private resources to address the challenges of sustainable development goals. And we recognize that the threat of climate change is very real to our development agenda. And of course, we act on our own, and we are very happy that we are exceeding our own goals in terms of the share of our activities related with climate-related benefits, and also all the work that we try to do in terms of disclosure, but including IFC, which has just included in its annual report the climate impact of all its portfolio, which certainly is a first amongst multilateral institutions. But we have also a sense that climate change is not something abstract or to the future. For many of our shareholders, it's very real, very intense, and we know that, for instance, 90% of the people in extreme poverty are actually in places that are either vulnerable to natural disaster or to climate risk or political fragility, and very often all the three operate together, one leading to the others. So what I think today this discussion shows that the network for greening the financial system is really a very significant leap, more than a step, I would say a leap in the way we can address the impact of climate changes in economies through a physical or transition costs in a coordinated, empirically based way that also seeks to give voice to investors, including individual investors' preference. And of course, for the bank to be a part of this network is very important. And we also represent the Sustainable Banking Network through IFC. And I think this network, which we have here, 2 representatives, is extremely important because it shows the seriousness that emerging markets are taking these issues. And being in Indonesia and also having here the bank Negara of Malaysia and Morocco is also quite inspiring to see the role that Sharia compliant mechanisms can have in addressing these issues. So we don't have representatives of the private sector in the panel, except for Martin. But we heard enough about the fact that there is a demand by investors, by the private sector, by savers also to inject and having the ability to express their preferences to support, say, sustainable investments. And I think there's this pent-up demand, and the conversation between savers, institutional investors, asset managers, and private sector associations with regulators and governments, it's really a priority to move the needle. And the World Bank has been part of this with green bonds and a number of other initiatives, also with institutional investors, and discussing how to integrate ESG principles in their fixed income portfolios, as well as the discussion of the risk profile of infrastructure, a theme that Martin raised a few times, and realizing that actually the risk of infrastructure credit, and in particular in green sectors, is probably less than is usually perceived, and could have an impact on the capital charges, regulatory capital charges, with an impact on the risk appetite for investing on this. So, and this conversation, we hope to continue it in the investor forum that we're going to have just before the G20 summit in Buenos Aires. And I think it's really part of this general effort. In sum, I'd say that we really have to be aware that the availability of finance is a key challenge in facilitating a systemic transition, because we know what gets financed is what gets done, but we have more and more elements to do this, and we really must keep our ambitions high and act accordingly with the right sense of urgency and also the intellectual rigor that initiatives like the network really offer to address these issues. So I'd like to thank you all for having been with us, and we hope you continue this work together, because this is basically to address existential issue with a tremendous impact in our lives and, of course, of our children. Thank you very much.
Thank you very much.
I think for the panel, we have a picture.
I think there's a photo.
Probably a family picture, so to memorialize this moment. Thank you very much.
Okay, thank you very much.